Imagine I told you this. Today, exactly 300,000 Bitcoin were bought and exactly 300,000 Bitcoin were sold. Yesterday, the same. Last month, the same. And back in 2017, essentially the same. So why doesn't Bitcoin always have the same price? How can an asset that always has the same number of buyers and sellers rise from a few $100s to over $100,000? After all, every buyer needs a seller. If that's true, where does the price increase actually come from? This question reveals something much bigger than Bitcoin. It reveals how all prices are formed. And Ludwig von Mises explained it nearly a century ago. Most people picture supply and demand like two buckets of water. More buyers, price goes up. More sellers, price goes down. It sounds intuitive. But it isn't how markets actually work. Because every trade has exactly two sides, a buyer and a seller. If 10,000 Bitcoin changed hands today, there were exactly 10,000 buyers and exactly 10,000 sellers. Not one more, not one less. So, if the numbers always balance, why does the price ever move? This is where Austrian economics begins. According to Ludwig von Mises, objects doesn't contain value. Not gold, not houses, not bread, not Bitcoin. Value exists only inside the minds of acting individuals. The buyer values the Bitcoin more than his money. The seller values the money more than the Bitcoin. Otherwise, no trade would ever happen. The market price is simply the point where two subjective value judgments meet. Nothing more, nothing less. Imagine an auction. There's only one Bitcoin. 5 people want it. Their bids are 50, 70, 90, 100 and $110,000. But the owner says, I won't sell below $130,000. What happens? Nothing. There are buyers, there is a seller, but no transaction, no market price. The next day, the owner changed his mind. I'll accept $110,000. Instantly, a trade happens. Notice something important. The buyers never changed. The number of trades didn't increase. Only one person's valuation changed. Yet the market price appeared. Bitcoin works exactly the same way. In 2012, many people were happy to sell for $20. Today, those people either sold long ago or became long-term holders. Many current owners believe Bitcoin could someday reach $1 million. If that's what they expect, why would they sell today? Their reservation price rises. The minimum price they are willing to accept becomes higher, not because Bitcoin physically changed, but because their expectation changed. And that's enough to move the entire market. This is where Austrian capital theory becomes interesting. Capital goods are valuable because they are expected to provide future benefits. A factory owner buys a machine because it will produce future income. An investor buys shares because they expect future profits. Many Bitcoin holders think the same way. Not because Bitcoin pays dividends, but because they expect its purchasing power to increase over time. Their decision isn't, do I want money? It's, will holding this asset leave me better off tomorrow? As expectations improve, selling becomes less attractive. Eugen von Böhm-Barwerk, a explained the people generally prefer satisfaction today over satisfaction tomorrow. This is called time preference. To postpone consumption, people require an unexpected reward. Entrepreneurs invest. Savers postpone spending. Stock investors hold shares. Bitcoin holders postpone consumption for exactly the same reason. If they believe future purchasing power will be higher, their time preference falls. They become willing to wait, as fewer people choose to sell. The economically available supply shrinks, not physically, psychologically. Mises emphasized something often forgotten. Human action is always based on expectations. Imagine two different worlds. In the first, everyone believes Bitcoin has reached its peak. Most holders become willing to sell. Now imagine the opposite. Everyone believes Bitcoin is only getting started. Almost nobody wants to sell. Nothing about Bitcoin itself has changed. The software is identical. The blockchain is identical. The supply hasn't changed. Only expectations have changed. Yet the price can rise dramatically. The same phenomenon appears in stock markets. Take Nvidia. Investors don't buy because of today's earnings alone. They buy because they expect artificial intelligence to transform the future. As prices rise, attention grows. Attention creates FOMO, fear of missing out. New investors become willing to pay higher prices. Existing shareholders think, if the future is even brighter, why would I sell today? Supply dries up. Demand competes harder. Prices rise. Not because more shares exist, not because more trades occur, but because millions of subject expectation changed. Bitcoin behaves exactly the same way. Over long periods, several forces work together. New supply grows more slowly. Long-term holders become less willing to sell. New investors continue entering the market. Institutions accumulate. Companies accumulate. Some governments even discuss holding Bitcoin as a reserve asset. Every new buyer must convince an existing owner to part with their Bitcoin. If owners demand higher prices, the market price rises. Friedrich Hayek added another crucial insight. Market prices are information. No single person knows the future. No central planner knows exactly how valuable Bitcoin is. But every trade communicates information. Every decision to buy, every decision to hold, every decision to refuse selling. All of that knowledge becomes condensed into one number. The market price. The price isn't just a number. It's society's constantly changing estimate of Bitcoin's value. The biggest misconception is believing Bitcoin rises because there are more buyers than sellers. That can never happen. Every buyer needs a seller. Bitcoin rises because human valuations change. Because owners demand higher prices. Because buyers are willing to pay them. Because expectations about the future influence decisions today. As Ludwig von Mises wrote, value is not intrinsic. It is not in things. It is within us. It is the way in which man reacts to the conditions of his environment. Bitcoin's price isn't merely the result of mathematics, or charts, or algorithms. It is the result of millions of individual human choices. And that's true for every market on Earth.